Hello, and welcome to today's episode of the Macrocast. I'm your host, Ylan Mui, a managing director at Penta. Joining me, as always, are my co-hosts, John Fagan and Brendan Walsh of Markets Policy Partners. Our friend John Dick, founder and CEO of Civic Science, is here with us as well today. Hello, everybody.
Hey.
Hi, Ylan. Happy Barbie blockbuster movie day.
We're going to definitely talk about Barbie today, so just you wait. But the big takeaway over the past week is that the consumer still is kicking. The consumer is still going strong. June retail sales looked pretty decent. Big bank CEOs are bullish. And of course, as we just mentioned, everything Barbie is sold out everywhere. So, John Dick, if you could kick us off here. I know that it hasn't been a straight shot up to the top, but it seems pretty clear right now that our joint economic sentiment index bottomed out back in the fall and that consumers are feeling a lot better now. So break it down for us. What are you guys finding?
Yeah, I mean, it's just, as always, sort of a mixed bag, where the ESI was up just slightly this week over last week after a pretty nice growth stretch 2 weeks ago. Again, it's sort of an amalgamation of a handful of different indicators. Attitudes toward the job market are still really strong, which is of course nice. People are a little more wary about the longer term view of the economy. So we ask about sort of like a 6-month horizon, and we saw that go down just a little bit this week. Kind of housing, large major purchases, all sort of like kind of right around average. So, but the net out was just slightly positive. So yeah, I think by and large, but where it's showing up is, as you mentioned, is in consumer spending. The consumer's not showing any signs of backing down, and obviously, the hope that inflation continues to slow will make that even better. All indications we have from our data is that Prime Day last week was a monster day for spending for Amazon, and obviously in particular, we saw pretty much like a 10 to 15% increase in the number of people who said they shopped. But not only did more people shop, but when asked whether they spent more or less last year, a large plurality of people said they spent more this year than they did last year. Now, obviously, that is on one hand, yes, a sign of spending. It's also a sign of deal seeking. What drove people to Amazon Prime is the opportunity to get things at a lower cost than they would otherwise. So they're still sort of looking for ways to stretch their dollars, but they're not clamming up their spending. We saw the highest sort of uptake in areas like electronics, some areas of home goods, less so in things like apparel, again, specifically on Prime Day. The other thing is that doesn't get nearly enough press is all of the other retailers who have their sort of so-called, events, Walmart, Target, Best Buy, again, all sort of seeing much higher participation than they did in years past, which again is sort of both a mix of, yes, the consumer's willing to spend, but also looking for ways to stretch their dollar.
Yeah, everyone has to follow Amazon. It seems like if they have Prime Day, everyone else has to have their own day too. It's almost like, Black Friday in the summer. But I guess one thing I was curious about in terms of the spending was people are looking for deals, but do you find that the spending is additive overall? In other words, are they just saving their dollars until they get to this big blockbuster event? Or is this money that are they spending more overall because of some of these special promotions?
It's hard to know, right? Because there are certain categories of things people don't buy on Amazon, right? We're not buying. There are many experiences, right? Services and things like of that nature. So, what we've watched really closely since the pandemic started is really how people are shifting their priorities in spending. So they're saying, look, I want to go to this place so that I can save my money on this category of goods, so I can spend up in this other category over here that I care more about right now. And a lot of that's being driven literally by like emotional and mental wellness. It's like what makes me feel better, and I'm going to save my money there. I mean, one of the most fascinating things that just bucks like 100 years of historical precedence is the extent to which like the prestige beauty category has been up over the last several months, year plus. Everything about the economic climate would say that a prestige category like beauty would go down in economic headwinds, and the opposite has happened. People are spending more in prestige beauty, and that's because the people buying in that category are saying, buying higher end skin products or what have you make me feel better. So I'm gonna retain and be persistent or resilient in my spending in this category, and I'm gonna find other ways over here or there to save some money. And it's just so complicated to understand what if the national data says that consumer spending on the aggregate is up, then I believe it, right? But it's not. It's not everything is up 0.3%. It's some things are way up and some things way down. Yeah,
right. My Instagram is filled with ads for Gwyneth Paltrow's $100 Goop Beauty nighttime elixir, which may say something about just my own personal needs, but also $100 for a nighttime elixir seems kind of high to me. John, what are the national numbers saying? Is it supporting this idea that the consumer still has some backbone here?
Well, I was just going to say that I've got a nighttime elixir that costs a lot of money too. It's called single malt scotch. And, I
think I like yours better than mine.
It has terrific effects. You can really see it working. Anyway, it's a very interesting, looking at the way that the data is interacting with the kind of perceptions in the market. It really is we've seen this soft landing narrative begin to pick up belief and a lot more credence given the data points that are coming in. And I don't want to split hairs too finely here. And obviously we're pretty early in earnings season, so when we're looking at we've mostly seen the mega banks, but when you see the mega banks come in, which bank did most poorly? Goldman Sachs. And we've got earnings from Visa and MasterCard next week, but we got American Express, and American Express showed it was the slowest spending in 2 years. Those are two real prestige brands, right? And so we've talked about this before, this kind of dynamic of the Patagonia vest recession, right? Where the high-end workers are, in tech, in finance, and private equity, and the deals are slowing down pretty dramatically. You've got layoffs in tech hitting the headlines, and maybe, just maybe, this is beginning to show through in some of the earnings that we're seeing bearing out in some of the numbers. Whereas the middle class and working class, the job market is still super strong in those categories. And this old idea, it was popularized by an analyst on Wall Street years ago, the idea that the U.S. economy is a plutonomy. It's a very, it's an evocative phrase, right? That the U.S. economy is driven by the rich and the ultra wealthy and the spending. And it doesn't matter so much what the middle and lower classes do in terms of their spending for the stock market and the economy. And maybe we're looking at an economy that's really flipped that on its head. And the trends are showing us something very different, where it's a much more bottom-up, kind of strength for the consumer.
Brendan, what are we hearing from the big bank CEOs outside of Goldman? I mean, there is optimism.
Yeah, and even the Goldman CEO was optimistic about the economy. They've just kind of made some mistakes in the past about, they got into retail lending, and obviously they rely heavily on capital markets. But the vast majority of the CEOs, from Brian Moynihan to Jamie Dimon, saw strength in the U.S. economy, and they, not that it's off to the races, but that the idea that we're falling into recession, it just isn't showing up in the data, and the consumer is hanging in there.
Has Jamie Dimon ever acknowledged that he was wrong? Sorry to go off script here. I'm just curious, because he was the one rattling the.
I think it was like
the recession. The recession's a month away for 18 months, Saber, right?
Yeah. He definitely had a different tone this time. I mean, obviously acknowledging risk on the horizon. The war in Ukraine and things like that. And actually, we obviously did see a negative development there this week with wheat prices rising. But that affects the U.S. less than it affects the global, especially the emerging markets, and especially the Middle East.
And really, on Wall Street, no one's ever wrong. Their calls are just early, right?
Just push back the horizon. In the long run, we're all dead, right?
Eventually, he's going to be right. We'll have a recession.
two other points in the ESI, the Economic Sentiment Index, that I thought were interesting, John Dick, were that confidence in making a major purchase rose, as well as confidence in buying a new home. And the reason I thought that was notable was because, we're still seeing mortgage rates at near 7%, but people still feel like it's a good time to buy. Is it ever not a good time to buy in these days, I wonder?
Well, I mean, keep in mind, it's relative a bit. I mean, they're saying it went up from where it was, a couple weeks ago or whatever, and it only went up. It went up just slightly. I mean, barely sort of outside of what a margin of error would be for survey data on a time period like that. So I don't want to maybe read into that too much. It's just saying maybe it's a better time than the worst time, right? Like. I don't think anyone's saying
held up.
It's a great time to buy a house
sure.
right now. I don't think anyone, yeah.
But it's held up. It seems like the demand has held up even despite the rapid run up in mortgage rates.
Sure. Well, and one area where demand is like off the charts right now is in car buying. The percentage of Americans who say they're in the market or will be in the market to purchase a car in the next 90 days is like climbing and climbing and climbing. And I think part of that is just because people sat on their hands for so long because inventories were bad and the economy was tight. And now all of a sudden, like people need a car. They've waited as long as they possibly could. So we're seeing that coming. And the other thing that's sort of hanging out there on the horizon, and I can't remember if we talked about this the last time I was with you, is the student loan payments coming back, hitting people's mailboxes in October. That's the demographic, the same demographic of people who say they're going to be in the market for a car in the next 90 days. Like, that's 43 million Americans who are carrying some substantial load of student debt. That they've been able to kind of sit quiet on those bills for a long time, and that's going to be a shock, I think, to the system when those show up. We'll see how that manifests itself. It couldn't come at a worse time right before holiday retail season. But we see consumers saying that they're going to delay certain major life events like weddings and things of that nature and trips. So that will have an effect. The other thing that, this is really kind of nuanced, but when these July electricity bills start showing up at people's homes, the heat wave hitting this country right now, and the 53% of Americans say they're running their air conditioners more than they ever have in the past, right? So like there's lots of things that could, because so much of the ESI has been really like, I don't want to say, well, tenuous for sure, but it's sort of like sometimes up a little, sometimes down. It's hard to know what's going to tip the scale, right? And there's definitely reasons to believe there's some costs that are going to hit consumers, and is that enough to like finally end this like resilient consumer spending? We don't know yet, but it's definitely something we want to keep an eye on.
Yeah, I think that's interesting because we seem like we keep waiting for the next shoe to drop and wondering what is that thing that's going to put the consumer over the edge and result in that pullback in spending. And it doesn't seem to have happened. And I came across a term, which I am so late to the game on over this past week, but this idea that, instead of talking ourselves into a recession, which we've been doing for a long time, that actually what we're just experiencing is a vibe session. That it kind of feels like maybe we're getting there, but then we actually never really get there, and maybe even it's over at this point. So I just wanted to get y'all's thoughts on that and this idea that are we just vibing a recession versus being in a recession?
I think it's somewhat simple. Like the job market is still incredibly, incredibly strong. The jobless claims just came in at like 228,000. That's historically low. If you need a job, you can get it. Obviously, the wage growth has moderated kind of back down to normalcy, coming from the weirdness that we had coming out of COVID, and then inflation spiked and then wages spiked. But inflation's coming down. Wages are still strong, and now they're actually above the rate of inflation. And the job market's still really strong. So, while people can worry about student loans, you're going to have to adjust your spending, but you're going to be able to afford it because you have a job. So I just don't, you're not going to go into recession with the unemployment rate at, 3.5% and us creating 250 to 300,000 jobs a month. It's impossible.
And by the way, I mean, it grabs headlines when these big tech company layoffs happen. And I don't mean to be remotely dismissive of it because it's a hardship for people, but we also don't talk about the generosity of the severance packages those people tend to get at those kinds of companies as well. So they've been afforded some runway as well coming out of those jobs. And those are skilled, educated, talented people that are going to find a job when they need one. As opposed to certain other categories of the economy and the job market that might not be afforded that same kind of runway.
And most of those jobs are sales and marketing, which, you don't have to be in tech to do those. You just go, find a job with, Johnson & Johnson or something like that.
Right.
The other thing I'm wondering in terms of the student loan repayments that will restart in October is, the Biden administration is still trying to find ways to maybe, ease that pain a little bit. And they've put out some new regulations around, well, if you make a certain level of income, maybe you don't have to pay back as much or over a longer period of time. And, maybe you won't accrue interest on the outstanding balance, and just trying to find ways to continue to mitigate the price of higher education. You can debate whether or not that's a good idea, but bottom line, it's not necessarily that all 43 million of those people with debt are going to see the full force of bills come back into effect all at one time. It might be more of a graduated, increase in what their monthly payments are going to have to be, or maybe even not at all, depending on what their level of income is.
And that's an important point on the level of income. When we do the average payment, I think it's $350. That doesn't say the story of what the reality of student loans. A lot of people, like 95%, have a small amount of student loans, $20,000 to $50,000. The 5% are the people that go to grad school, that become doctors and lawyers, that have $300,000. That's where the vast majority of student loan debt is. And all of those people have jobs. They can't afford to pay this back. So the picture of what the student loan market that is presented by the media is very, very unrealistic. It doesn't capture the reality of what student loans are.
I'm going to try to take the opposite side of all this and be a bummer. Nothing anybody said is wrong, but one of the things about the economy is you got to look at it from where are we going, right? Are we going into a place where things are going to get easier for the consumer? In some ways, maybe so, right? Inflation is coming down, but when we're looking at inflation, that inflation is coming down is essentially sort of a data-driven, sort of headline CPI based. Prices are still, the relief at the pump is already kind of in there, right? Are oil prices really going to come down from here? We certainly don't think so. And OPEC keeps cutting supply whenever they do come down. And we've got to refill the strategic petroleum reserve. Is it going to get easier for the student borrowers? Obviously not. They're going to have those payments come back. Is fiscal spending going to be better than it was? Well, we still have those residual outlays from the big infrastructure package and the Inflation Reduction Act. Those are still working through the system. And so maybe there is some pickup there, but, we're looking at overall, the big fiscal splurge for COVID is well behind us. We could even be facing a relatively lengthy government shutdown in the fall if, the Capitol Hill gears grind to a halt like they might in terms of this. It's not as risky as the debt ceiling, but a government shutdown definitely has an impact. And then there's the Fed. Markets are pricing in rate cuts, pretty steep rate cuts for next year. Those have been pushed out. Initially, we talked a lot about how they were priced in the fall and winter of this year, which was really premature. But, the Fed is really saying that they're going to have rates up for a long time and keep them level. And if we do have, level interest rates, the fiscal impulse is basically waning. You have additional payments coming in for the student borrowers, and you have, what's going to get better, right? And usually what gets better is, the economy picks up when there's, Fed stimulus, when there's fiscal stimulus, we haven't seen like a big organic recovery in the economy. That doesn't mean the economy is about to crash, but there are obviously like problems like commercial real estate, which are still very much working their way through. We have not seen the last chapters on the commercial real estate declines. And so, there's a sense that right now markets like there are a lot of people sort of blowing the all clear sign, safe to get back in the water. You even see the Biden administration bring up Bidenomics, right? Now that's risky, right? Because
you're going to own it up and down.
Yeah, because a lot of, as we talked about, the recession calls may not be wrong. They may just be early.
God, I agree. And the current data does not indicate a recession at all. But I agree that the Fed is the biggest risk to the U.S. economy. And they are fighting a fight that they've kind of won. And the risk is that they massively over-tighten and do drive us into a recession that didn't need to happen.
But isn't part of the goal here, though, for things actually to get a little bit worse? We just don't want them to get a lot worse, right? Because where we were at in terms of economic growth and consumer spending, et cetera, was unsustainable and actually potentially causing inflation, right? And fiscal spending as another factor there, important factor. So we want things actually to not look as great for the consumer and for the economy as they did maybe a year ago, right? But we don't want them to look really, really bad. And so maybe this is the Goldilocks scenario after all. There could still be a lot of external factors that we aren't accounting for, like what happens in Ukraine, et cetera. But maybe a little bit of shine off the economy isn't a bad thing.
I agree, but also John brought up a really important point about the commercial real estate. That's going to be an absolute disaster. We're going to have $2 trillion in losses. Starlight defaulted on a $212 million loan in a office building in downtown Atlanta. This is coming, and those buildings are completely worthless, and they're all underwritten at a 5% cap rate. So if the Fed insists on keeping the rates as they are, all of those buildings are zeros, and they're just going to be put back to the bank, and the bank's just going to, let them rot. So the Fed is going to have to cut rates somewhere in the next couple of years. It just depends on how quickly this slow moving disaster in the commercial real estate market happens.
Hey, longtime listener, first time caller here for you, for those of you experts on this. Everybody and their mother is talking about this commercial real estate crash. Like, it is not going to surprise anyone. Is there nothing that can be done about it? Like, is everyone just like, well, we're all screwed. It's just going to happen. We're just going to have to ride it out. Like, it seems it's
no, you have to cut rates back down to basically zero so that these developers can refinance at that rate and still, have a somewhat profitability, even with a 50% occupied building.
But you can't cut rates to zero to save commercial real estate.
That's $2 trillion. And you know who holds all that debt? It's regional banks. It's pension funds, and it's insurance sector. So do you want that's a nuclear winter if you let $2 trillion get wiped off those balance sheets. That means the baby boomers don't get to retire.
I mean, what John brings up, the fact that this is the worst kept secret in financial markets, right? The good thing about that is, you can prepare, right? You may not be able to mitigate all the damages, but you can, if you're managing your bank, right? If you're managing your pension fund, right, et cetera, you can hedge against that downside. You can prepare yourself for what, if you think it is inevitable, you can prepare yourself for that. And so that creates a differentiation between a bad scenario and a systemically risky scenario. There's a difference between losses and systemically, and cracks in the real foundation. And it's not impossible that even something that is predictable and likely and everybody knows it's coming can create some systemic shocks and bring down, bring down regional banks and that sort of thing. But it gives you the ability to prepare for it, and it gives policymakers, plenty of notice that this is coming. So it has less likely a shift, a metastasization into a really significant structural and existential risk to the economy.
John Dick, I know we don't have you for very much longer, so I wanted to get to another point that you raised is that, one of the risks that the Fed has worried about for a long time in terms of keeping a lid on, and in terms of making sure that inflation doesn't get out of control is this idea of a wage price spiral, right? That if the labor market gets too hot, workers start demanding higher wages, that creates more inflation, et cetera. We are starting to see some unrest amongst amongst labor unions, unrest amongst employees who are demanding either not just higher wages, but better working conditions. And that could have impacts on the economy and on the supply chain.
Yeah, I mean, no doubt about it. The striking, I mean, heck, it's happening in Hollywood, right? And it's, but the, you know, the one we're watching, look, we don't look at the sort of, maybe look at this the way you guys do from your point of view, but like the UPS strike that's sort of like lingering out there, the Teamsters UPS strike, it's estimated that it'll have the most significant economic impact of any strike in U.S. history if it happens, right? And what we're watching is like, what's that going to do to things like online retail? You know, if I was the Teamsters head, I would have been threatening that strike 3 weeks ago before Prime Day and all these retail events, right? You want to talk about something that would have been you know, extremely painful, but clearly there are growing groundswells of workers saying, look, the CEOs are making too much money. We're not making enough. And they have the tools to organize right now. And they have a lot of leverage on an economy that feels like sometimes it's teetering. I would be shocked if this thing doesn't get resolved because of how severe the implications could be. But we're watching it. We're just kind of curious to see how the consumer shifts their behavior, right? Will they go back into stores to shop because they can't get the thing delivered to them from the e-com site they're used to buying from, or will they seek out e-commerce retailers who don't use UPS as their primary delivery partner? Whether that starts to create a groundswell of more and more you know, strikes or strike threats, I think will depend a lot on how this one plays out. I mean, you're kind of damned if you do, damned if you don't. If UPS and the leadership sort of acquiesces to the demands of the unions, then you're going to see more unions get emboldened to do more things like this. So it's going to be August 1st, I think, is that contract expiration date. It's going to be a pretty wild next 2 weeks or so till that unfolds.
Yeah, and stepping back, it's just indicative of, you know, what we've seen from the pandemic, which is the pendulum swinging back in favor of labor and the bargaining power that labor has at the table. And that's long term, that's inflationary, and or at least puts a floor under inflation and prices. That's obviously something that we saw during the pandemic in a very intense kind of way. But going forward, you know, is it all negative? You know, obviously there's an equality issue, and the middle class falling behind, and working class wages falling behind. And so there's, you know, it's not all negative, obviously, to have these kind of dynamics and have this be addressed. But, you know, the common understanding is that it does have, you know, on the margin, an inflationary impact going forward.
But if we think about, I guess, this from a worker's point of view, at the end of the day, if a worker has more money and it doesn't result in a wage price spiral, which we hope won't happen, but they have a little more money in their pockets, then, you know, that ends up being a good thing for the economy and a good thing for consumer spending, which is the driver of economic growth and economic activity in this country. So I think there are definitely two sides to that.
Absolutely. And that's Bidenomics right there. You said.
That's right. So in our final minutes here, just want to see what's on tap for the coming week. Brendan, is anything on your radar screen?
A very busy week next week. So we have the Fed, who is the market is now priced in 100% chance that they hike on Wednesday. The debate is whether they do another one at the end of the year, where a lot of economists think that this is the one and done, and then we're on hold for a long time. The ECB is also has a meeting. They're expected to hike, but their data has been much weaker than it has been here in the United States. And then the Bank of Japan also. Today we're seeing the yen have a fairly significant move after the new governor, indicated that there's not expected to be significant change in policy. So it's going to be a very busy week on the central bank front. And then on the data front, we get all the market S&P global PMIs, both manufacturing and services. So that'll give us a good insight into how the economy is doing in July. And then earnings season continues, with busy busy times. We have, let's see, Microsoft, Boeing, AT&T, Chevron, Coca-Cola, Ford, McDonald's, MasterCard, and Visa. Yeah, so we'll get a decent insight into a very wide breadth of the U.S. economy.
Yeah, it's very consumer heavy this week coming up. It's a little bit light on tech. We saw tech come in, not so great with Netflix and Tesla. Really disappointing investors and analysts with their results. Microsoft is the big tech name next week, but this is going to be one where paying attention to what management is saying about demand and the outlook for demand across these various categories of big household retail giants. It'll be very interesting to hear.
Interesting with Microsoft. Microsoft rallied very much this week because they announced that they are expanding their Chat GPT functions, their AI functions, into a product within Microsoft 365. They're going to charge for it. So we're seeing the monetization of artificial intelligence, and the crypto kind of sector was very exciting, but we haven't figured out how to monetize it. AI has been able to be monetized kind of right away. So there's fears that that this rally in tech is very much AI driven, but it's a bubble. It could be a bit of a bubble, but they are making money off of this. This isn't a theoretical thing anymore.
You know what else is making a lot of money or could potentially make a lot of money? The Barbie movie.
Exactly.
100.
Maybe the sequel is going to be written by AI and not by humans.
You imbue Barbie with AI, right? No, but $100 million in marketing this movie. It opens this weekend. I'm taking my daughter and her friends to go see it. We're totally bought in, literally and figuratively. I know, John,
you get dressed up?
Oh, yeah. I've got my pink outfit. She's got her pink outfit. Her friends have got their matching pink outfits. So, don't try to buy anything pink on Amazon right now.
My daughters are similarly excited. I'm going to spare them my dress up as Ken. I'm just going normal. No one wants to see that, so I'll just go in normal.
I think you can buy Ken's vest actually on one of the costume sites. Maybe that could, I don't know. Maybe there's a Macrocast Halloween edition.
Dress up as your favorite economist.
Ken is your favorite economist. Anyway, that does it for us today. I'm Ylan Mui with Penta. My co-hosts are Brendan and John from Markets Policy Partners. Thank you to John Dick of Civic Science for joining the fun as well. We hope that you enjoyed our show, and please remember to like and subscribe to the Macrocast wherever you get your podcasts. Thanks for listening.